Before we get on to the presentation, I just want to share the recently posted content we had this week. Just today, we posted those final two presentations from David and Fernando, refining a bull put credit spread search, where David felt he was seeing some things that were unfillable, positions that wouldn't be able to be traded, and wanted to filter them down. So we gave him some ideas. Fernando wanted to know, can he use the option chain to sort of determine a direction of an underlying security? Then we took a look at collar structures, expectancy, profit potential, risks, and others. We had a presentation on how to repair a covered call when the stock gaps up, rolling a deep in the money covered call, and other ideas that one might be able to look at in that case. We talked about when and how will an in the money covered call be assigned, and we reviewed some of the general market ideas of how that goes. And can we use the stock repair tool for a purchased long call that is losing in value? And of course, in other presentations, should I close a covered call just before expiration to avoid being assigned in the after hours as well? So that's some of the recently posted content, all of them available up on YouTube, public videos. Just find us under Power Options. Fantastic. Now, all that being said, we're going to navigate over to the Power Options suite of tools, which we're going to use to illustrate the questions that come in, and of course, our thoughts and our answers on those questions as well. Okay, there we go. So here we're just looking at a basic 14-day free trial account. And Pete says, good afternoon. Pete, good afternoon. It's good to see you here as well. Now, our first question that came in via email was from Ben. And Ben says, I have a long-term holding that I want to generate some income. I want to generate some income against, as we all do. Now, I'm thinking about cash secured puts 1 month out at a time. The put would be deep in the money, and I have a price that I'm comfortable buying the stock at. I don't want to use covered calls because I think the stock has a long way to run and I don't want to lose out on the run-ups. I'd like to know how to use the search tool to find the best risk-reward ratio for cash secured puts. I'm also curious if the put should be shorter term, 1 month, or longer term. Okay, so first, what are we talking about here? Now let's go to square one. I'm going to go to the portfolio tool. I'm going to use for maybe some other topics in today's presentation. And let's say that I have a holding of Apple that I have for a cost basis of 137. Apple's currently up at 151.28, so we've got about a 10.4% unrealized gain on this position. Now, naturally, if I link to tracking it in the portfolio, if I go to position actions and then position analysis, it may show me some potential rollout opportunities or adjustments that I could use for this long stock position. So we see we could write a covered call for income. We could increase our 10.4% return up to potentially a profit of 18%, 15%. And this is going out to that standard 30 days we were talking about, December 17th, some shorter term, November 26th, and 14 days out, November 19th. I wanted to illustrate this real quick for Ben because, as you can see, the highest return is going to be the ones further out in time at relatively the same strike. Here, the 23rd of December 155 call, we would take in 318. If assigned at that price, which is not your goal, I understand, but we'd make 15.8%, an additional 5.4% from where we are right now in 48 days. Now, if I sold the 26th of November 155 call half the time, 21 days out, it's only a 14.3% return. I'm only increasing my return by 3.9%. However, the annualized percentage return shorter term would be much higher. If I was able to do that every 21 days, get $1.40 every 21 days, we'd potentially have a higher annualized return than selling further out in time. Then there's some other concepts here of converting the position to a collar, and sometimes we may even see converting this position into a married put trade. But none of this is what Ben wanted. What Ben wanted to know is evaluating selling an in-the-money cash secured put against shares of stock he already owns to generate income at a buy price that he's comfortable with. And what would that look like? Now let's go to the Custom Spread Tool, and we'll put in Apple again, 100 shares, just to keep the math fairly simple, with our cost basis of 137, with that unrealized 10.4% gain. Now, instead of a covered call, I go 30 days out in time. Next expiration, let's go 42 days out to December 17th, as we saw in the rollout opportunities. And let's say I was comfortable buying Apple right now, 155. That's slightly in the money, really at the money, but slightly in the money. And we can get a price of 680. Now, let's just run this first. I want to run this first. Oops. I did that reverse. I'm sorry. There we go. I forgot to click add stocks. Let's put that in. Our 100 shares, 137. We're going to sell a December 155, slightly in the money put against it. All right. So what does this do to our position? We get an additional 660, 665 against our cost basis. We lower our cost basis from 13,700 down to 13,038. But I have to put up the cash secured amount. So now I have $28,537 roughly in this position. 137 for 100 shares of stock. We got 663 back, but I've got to put up 155 to cover the short put obligation. So we've essentially doubled a little bit more our monetary accounting. I won't want to say our monetary amount. We just have this on hold for 42 days in this example. And we leave the upside open because the sold put can only make that $6.63 as the stock moves up. If it goes up to 155, 160, 170, we're only making the 663. We still have unlimited upside, of course, on the 100 shares of stock. Now, what is the best one? Well, it depends on your true goals for the position. Let's go to the option chain, and I am just going to stay at this moment in December, Ben. I'm going to look 42 days out as a comparison. Okay? And let's go to a medium chain. It might be a little bit big, but I'm going to go to a medium chain. Now, you had asked about using the search tool to identify positions to find the best risk reward against stocks you have as permanent holdings. I don't think I would do that. I would go individually each stock. There's another way to do it. I might talk about that. But if you only have 2 or 3 stocks, I would just go to the option chain. And I'd be evaluating the view here based on what is the naked yield for each one of these positions, whether in the money or whether out of the money on these positions. What is the time value? I have that selected here. Which one is giving me the best time premium between in the money and out of the money? Now you're looking at raw premium. Now you're saying, hey, I can get 663 for this slightly in the money 155 put. I could get 1030 for the 160 deeper in the money. 1465. Hey, if the stock goes up here, I lowered my cost basis by 1465. Well, that's true. And if it doesn't move up, you're at the buy point that you wanted for this position at 165, and you collected 1465. What I'm looking to illustrate here is that at the money bell curve. Are you trying to collect raw premium, or are you trying to collect time value on a consistent basis? If I'm focused on the time value, which helps with this percentage yield, you see you get a lower time value as you go deeper in the money because most of this is intrinsic value. And down here, we're all time value. And as we know, the highest time value always occurs right at the money. Here it's at the 150 strike and the 155 bend. That's where the highest time value is, known as the at the money bell curve, where here is the highest time premium at any option at any time. on the current chain, the one that's closest to the stock price. In the case of puts, those that are out of the money are going to have a lower time value. Those that are in the money have a higher premium, have a lower time value. You had asked about the best risk reward. Well, you're obviously planning on owning more shares of stock, which is why you're selling in the money puts to begin with. And you're hoping that the stock moves up so you can get it at these prices, or that it'll expire worthless and you've collected more premium. Most investors that might approach this way, I can tell you that I've talked to, are at to slightly out of the money. So even though I'm only collecting $2, $3, or maybe even slightly just $6 here, if the stock moves up slightly as I expect, I can still have it potentially expire worthless with a good premium. The highest premium is up here, but do I really want to buy shares of stock again at 180, even though I collected $28.95 against it? Well, that's almost intrinsic, isn't it? It's only 0.2% time premium. You're getting a lot up front, but if the stock stays right where it is, you bought another shares at 180, you kept in, let's call it $29. So what does that mean? You're forced to buy shares of stock at 180. You keep almost the full $29. That was almost the same as buying another 100 shares right now at 151. It's essentially an intrinsic. Okay, so you'd own another 100 shares at 180. You collected $28.95, but the stock's still at 151. So you now have another shares at 151. What I'm saying is that if I buy it here, if I sold the 160 and got 1030, if the stock stays where it is, let's call it 151, and I'm assigned at 160. My cost basis is now 149.70. If I went to the 170 at 1925 and the stock stays at 151, I buy another 100 shares at 170. We keep the 1925 premium. So now my cost basis is 150.75. Only 50 cents less than buying another 100 shares right now at 151.28. But if I sold the 155, the slightly in the money put, and got, let's just call it 665 in this example, if I get assigned, if the stock stays at 151 and I get assigned at 155, the cost basis of my new 100 shares is going to be down to about 158.40. You see, that's giving me essentially the lowest break even if this was sold as a naked put position. These here would be right at about the same cost of buying the stock today. This would put me down in the 140 range. 148, 149 range. This also would get me down to that 149.70 or closer to 150. But as you go deeper in the money, even though the premium is higher, Ben, it's mostly intrinsic. So getting assigned at 175, that deeper in the money strike, is almost the same as getting the stock right now at 150. The positions slightly in the money, slightly out of the money, and at the money that give the highest time premium are going to be the ones that give you the best new cost basis for the position, as opposed to just taking the money you would put up for these put options here and using that just to buy another 100 shares of stock at 151. The only way you get a lower cost basis is with the good time value, 1%, 1.5%, 2%, which you find it at or slightly in the money. That gives you the better cost reduction going forward if you do want to be assigned at those prices. Out here, where it's essentially just intrinsic value, although it's higher, you're at a cost basis essentially of just buying another 100 shares right now instead of selling the put options against it and having them cash secured. Why not just buy the shares right now then? It's not really for an extra hedge because you're still going to get put the stock at these prices. This at least gives you a $6 hedge. Okay, $2.75. Is that what I'm looking at here? The stock at 151.28. We're getting 663. Oh, actually, I'm sorry. It's about 515. You're getting 515 of a hedge with that extrinsic value, that time value. But as you go deeper in the money, you're not getting anything more because there is no time value. And you see down here, even 42 days out, further out of the money, hoping that expires worthless, you're only getting 25, 30, 35 cents. So if you wanted to use this approach to hedge your portfolio on your core holdings, because you want to leave the upside open in case of a large run-up, but you also want to help it lower your cost basis, sort of averaging down if you are assigned, you're going to be here. Almost the three bears, slightly out of the money, we call it at the money, but sort of at the money, slightly in the money, or maybe slightly out of the money. You said you wanted to go in the money, but don't go too deep in the money where it's all intrinsic and there's no time value because you're getting no hedge on your position. Now let's use the search tool, as you mentioned, a different way to compare this risk reward. And I'll show you what I mean. So we're going to go into the naked put search very quickly. And I don't have it as one of my available strategies based on other conversations that we've had. So let me go to other strategies and let's remove that. And I'll go to naked put. There we go. And we'll go into the search. Now, of course, the patented search tool for any strategy does what? It scans across the entire universe of options to find only the positions that match either your saved search or one of the power options default criteria. You see here that we're looking specifically at the weekly picks of the day default screen. But what I want to do in this case is evaluate one or two ways of just to search one stock at a time. For the sake of the example, let's stick with December, natural expiration, 42 days out. So let me clear everything out of the table and we'll select standard December. I don't care about implied volatility for this search. I don't care about naked yield. I do care about the percent to break even. I want that to be the percent to break even to be at least 1% perhaps against the current stock price. What does that mean? That means I'm getting a lower cost basis if I'm assigned by at least 1%. That's one way that you could get that 1% I was mentioning. In any case, no, it's going to be more than that, but in any case, I'm not going to worry about in or out of the money. You could put your number of strikes in that you wanted to be in or out of the money. What I am going to do is also put in at least a 1% time premium. I'm not going to worry about bid-ask spread. I'm not going to worry about open interest. I'm not going to worry about any of that. What I am going to do now is we're just going to go into fundamentals, and I'm just going to screen against AAPL. Okay. So the December series with at least 1% of time value, which I didn't add here, but at least 1% of yield, and that percent to break even, we're going to have to adjust these columns. So let me change these columns. This is for a different webinar. We had all this implied volatility stuff in that we don't need today, but you can add all of that in. I'm going to take out implied volatility and delta. I'm not going to worry about probability. I will leave probability in. I want time value and percent time value. I don't want gamma, I don't want theta, I don't want vega, rho, percent option, and percent implied volatility range. I do want break even and percent to break even. Let me just change the column order just to make sure everything is in line. So that's good. Option bid. Okay, I'll add another thing in there. Naked yield, probability above. Let's move that down. But time value, percent time value, break even, percent to break even. Okay, fantastic. There we go. All right, why did I change all of that? Because in my opinion, what are we looking at? There's the 150, the at the money, which has what? I'm sorting by the highest naked yield if this is sold as a cash secured or a naked put. Time value, monetary midpoint, 372, the 155, 291, the 145, 206, the 160, 158. And you see that the time value is pretty much equal to the percent naked yield. You might not need both. I just put those both in there. Okay. And then you have your percent to break even, which means what? How far can the stock fall from where it is right now before you're at break even? Or, let me clear this up, another way of looking at it is, what would the cost per share be if you were assigned on any one of these positions. If I was assigned at the 150, my cost per share would be 146.28. That 155, 148.38. The 145 is just out of the money, 142.94. But this one again is slightly out of the money, not the in the money range you mentioned, Ben. And the 160 gives you a cost basis of 149.70. Why am I not seeing the 165, the 170, the 175, exactly what I just showed on the option chain, Ben? They're not here because they didn't give at least 1% of time value where it would help you to actually reduce your cost basis and average down. You go too deep in the money with too little time value, it's almost not even worth it. So here is an idea that you can use. Just create a basic search looking for some basic time value, 30 days out, set your expiration, basic time value of 1%, that percent to break even, sort of the downside protection of at least 1%, how far the stock can drop. The ones that are below that, I don't think are going to give you enough time value for what you want, this approach you're considering. Now, all that being said, can I save this search now? Yes, I can. What this doesn't do is save this field. This is a one-off field that isn't saved. But if you had a list of 5 or 6 stocks, Ben, that you wanted to save to run this basic search with 3 criteria on your expiration, percentage time value desired, and percent to break even. And like I said, you might not even need to use the percent to break even. But the percent time value or the percent naked yield, you could, of course, just create your own personal stock list. Just go into that field, create modify list on the list tab, click create list, and I'll just could type in my symbols for Apple, BX, the core holdings in your account. That should have been a comment. And then once you create that list and save it, you can select it from this drop down and screen just against your stocks against those 2 criteria that you wanted to see. Save those, and then you're all set. You're looking at which naked or cash secured puts against your core holding stocks are 30 days out and have at least a 1% time premium. Let's go back to the option chain very quickly for Apple. And Ben, I see your comment. Ben said you should put in the actual percent time value midpoint on the option chain. I was going to do that on the search when we were looking at it there because I was mentioning the actual numbers, but we can put those different things in here as well. The exact midpoint, the put option, not midpoint price, but the actual midpoint time value we could put in as well. I came here because I wanted to see. I want to take out something. Oh, it is already there. I apologize. Good. I want to take out. Okay, that's fine. Good. All right. Oh, sorry. Let's go back to our 42 days out. Here is another example of what we are attempting to illustrate, Ben. The yield essentially is showing you that time value. Here is the annualized. And where is the highest annualized return? It's right at the money. As you go deeper in the money, that goes lower because most of what you're collecting is intrinsic. It's not giving you a better break even. It's not giving you a better cost basis. It's essentially the same as maybe buying 100 shares of stock right now at that price. Because if I sold that 175 or that 180 and the stock goes the opposite way and drops down to 130, I'm paying 180. Sure, I collected $30 or $28.95. It's almost the same as just buying the stock right now at this price. Didn't get much of a hedge. Your hedge is right there at the heart of the at the money bell curve for this attempted approach you're considering doing in that case. Now, keep in mind, another approach we could use if you wanted to generate premium. And I didn't mean to do that. I want to close it. I wanted to go to it. Let's go back to the custom spreads there for 100 shares of Apple. At 137. 37, Mike. And I'm going to stay with that. Maybe it looks like the 150 was giving me the best bang for the buck. You want it to be in the money to maybe get assigned more. The at the money is at 150. Okay, I'll stay with the slightly in the money one we've been covering. We'll stay with the 155 at midpoint there. Now the risk is, let's just put this at a nice even number at 660. The risk here is that I've doubled my cost basis. I've doubled the monetary requirement I have in this trade. I already have the 13,700 in. We're reducing that by 660, but I've got to put up the 15,500 for the cash secured put. So now if the stock falls 10%, falls 15 points down to 140, okay, I'm still just a little bit below break even. But if it falls down to 130, I'm losing now on the naked cash secured put and my shares of stock. I've increased the risk to the downside with this potential trade. Now, I'm not saying you're going to get $6 worth of premium, but another approach you might want to consider to take advantage of getting some income, but leaving the upside open for high movements up. We'll stay in December. Let's give ourselves some cushion. We'll, of course, get the 155 call. That's only at about 282, 283. But let me take away about a third of that and buy a 165 call. So I'm not getting as much premium as the cash secured put, but what am I not doing? I'm not putting up any further requirements monetarily for risk to the downside. My risk doesn't go up to 28,000. I still have an unlimited upside for large run-ups. What did I do? I sold a 155 call. Yes, that's at the money, slightly out of the money. I may need to roll it, but if the stock does gap up 162, 163, 170, 175, I'm still gaining on this long call. I may have to deliver shares of stock, but I have this call here that's increasing in price. What is this? It's just a bear call spread done against a stock. In radioactive trading, this is income method number 6. It's one of the ways that we can use income against the limited risk married put to further reduce risk and leave the upside open. It's a bear call spread. I sold a 155 and bought a 165. It leaves the upside open because even though I may still be obligated to deliver shares at 155, if it really takes off, this is still gaining, or I can choose to exercise this down the road, buy back in at 165, even if the stock's at 180, and then continue to do it. And I reduced the total monetary requirement from this credit that we took in, rather than doubling it, selling the cash secured naked put position. Okay, that's what we're looking at in that case. That's just an alternative idea. But again, Ben, directly related to your question, I'd say that you want to get at least a 1% time premium if you're selling these puts 30 days out in time. You want to be able to make sure you're reducing your cost basis effectively if you do get put the stock. Going too deep in the money on those puts, those further in the money puts, will give you a higher upfront premium, but there's really not a lot of time value you're collecting in that case. And so there runs in the problem. We are not effectively, in a sense, reducing your cost basis. I'm not saying you're paying more. I'm not saying that at all. But you're doubling, or almost in some cases going up 1.5% or 150% of the allocation you have now to do this to cover the cash secured put. If you want to do that, I want to make sure I'm getting the most time value to get the most cost basis reduction if I am put the stock, even if I'm starting off just 1 or 2 strikes in the money instead of deep in the money is the question that you gave. But if I don't want to double or triple the monetary requirement at this time, I understand that your approach is to accumulate more of the stock that you consider core holdings in your account. You might want to consider that bear call spread, selling the at or slightly out of the money call, but then buying a higher strike call. Your broker just sees it as a covered call with an extra long call, so there's no extra margin requirement, that 5 points to cover between the spread. It leaves the upside open if there's a large run. You still get some income in to help reduce the cost basis. And if you decide later on to accumulate, you could do that through the naked puts or just buy the stock directly. But you're not starting off immediately with doubling the cost basis on the position.